Welcome to Regulatory Ramblings. Our podcast today is brought to you by the University of Hong Kong's RegTech Lab, the HKU SCF FinTech Academy, the Asia Global Institute, and the HKU edX Professional Certificate in FinTech, with support from the university's Faculty of Law. I'm your host, Ajay Shamdasani. The unifying theme for this episode is payment systems and their challenges. In today's initial spotlight section, we'll be speaking with a returning guest, Syed Musheer Ahmed of FinStep Asia, and Monica Jasuja of the Emerging Payments Association Asia, on a recent LinkedIn post of Musheer stating that the lines between traditional finance and DeFi, or decentralized finance, haven't just blurred, but they've merged, owing to the SWIFT organization's announcement at its annual conference in late September that it will add a blockchain-based ledger to its infrastructure stack to hasten and scale the benefits across over 200 countries and territories worldwide. Following that, we'll be chatting with finance and technology lawyer Konrad Borowicz. He's an assistant professor at Tilburg Institute for Law, Technology and Society in the Netherlands about a paper he recently presented entitled Extraterritorial Frictions in the Law of Cross-Border Payments. That paper was presented at the European Central Bank's Legal Research Program seminar in Frankfurt recently. But first, why does the SWIFT organization's action matter? Well, the network is used by over 11,500 financial institutions in more than 220 countries, making it the backbone of international finance. Essentially, every corner of the world uses it. Quote, it facilitates the transfer of value between banks and globally underpinned by its messaging service, and roughly every 3 days, the world's GDP passes through their network, end quote. And coming back to Musheer's post, quote, if a bank or financial institution has SWIFT rails, they are likely to continue to leverage the TradFi institution, which is basically owned and run by the banks as a collective, to underpin their tokenized finance initiatives, end quote. SWIFT is, and a group of more than 30 financial institutions globally will develop, under the new initiative, a shared digital ledger with initial focus on real-time 24/7 cross-border payments. Specifically, SWIFT will work with Consensus, founded by the co-founder of Ethereum, on a conceptual prototype of the ledger, which will leverage SWIFT's unmatched resiliency, security, and scalability to facilitate transactions using any form of regulated tokenized value. Separately, building on earlier pilots, SWIFT will also add capability to support interoperability across existing and emerging systems for various use cases. As Musheer puts it, quote, developments are part of SWIFT's strategy to power a best-in-class experience through innovation on parallel tracks, upgrading existing rails while creating future digital rails to maximize infrastructure choice for the industry. The initiative will see SWIFT partner with the Bank of America, Citigroup, NatWest, and others to develop a shared digital ledger for tokenized assets, including stablecoins. It will combine straight-through processing and value plus messaging capabilities on a single platform, which is used by every major bank. And as for Musheer, he has over 18 years of experience, is an ecosystem builder in the realms of capital markets, fintech, and virtual assets, including a decade as a global markets trader prior to coming to Hong Kong to attain his MBA from HKU and London Business School's joint program. Since 2016, he's contributed extensively to building the region's fintech and virtual asset ecosystem, particularly as the co-founder and concurrent board member and the inaugural general manager of the FinTech Association of Hong Kong. For almost 5 years, he's been the managing director of FinStep, a firm which he founded, and the interim from October 2022 to January 2024. He served as a financial market risk assurance lead with the Virtual Assets Regulatory Authority in Dubai. Monica Jasuja is the Chief Expansion and Innovation Officer for the Emerging Payments Association Asia, and she's the advisory board chair of the FinTech Fusion Group in India. She's a digital business executive with over 20 years of global experience in strategizing, defining leading and building and deploying commercially viable, innovative software products and solutions, primarily in the financial services realm. Her focus is solving for consumers and digital payments and consumer products. It's a passion that she's continuously aimed to learn about and support business in their growth. She's an accomplished product leader, having managed multi-year strategic initiatives across design, development, deployment, and go-to market, primarily, again, for financial services. And she boasts extensive international exposure in multiple geographies, such as the US, Singapore, Taiwan, and India. Since 2017, she's spearheaded the new vertical for large digital players, design emerging fintech leading initiatives across sales, business development, product, and other cross-functional areas, including legal, marketing, and policy, to create new revenue opportunities and expansion opportunities of payment rails in India. And with that, I will turn over to our guests, Musheer and Monica. Thank you so much for joining us.
Thank you for having us, Ajay.
Thank you. Pleasure to be here.
Okay, so Musheer, turn to you first. When you say the lines between traditional finance and DeFi haven't just blurred, that they've merged. I mean, this came up during our last episode as well with Stanley Foodman, and it's a recurring theme. Multiple people are saying the same thing, but I'd be keen to hear your perspective. How did you come to that conclusion?
I got to be careful with what I post and how I quote it, right? But it's a good thing because it leads to a conversation to take it forward. A couple of things for us to keep in mind. Blockchains used in financial services with regards to traditional finance and regulated finance isn't something new. We've had various attempts at consortiums run by R3, Hyperledger, and others.
So we should no longer look at crypto and virtual assets as a fringe thing.
I want to make a distinction between crypto assets or crypto or virtual assets as they were versus tokenized and blockchain-based financial instruments. The reason I'm making this distinction is most of the crypto assets or virtual assets from Bitcoin, Ethereum, etc., these are native blockchain assets that are generated on the blockchain systems, while tokenized finance is about bringing on board existing financial products or similar instruments onto the blockchain through the process of tokenization and leveraging of the blockchain for facilitation of transactions between tokenized instruments. So when we talk about the blurring of the lines, quite clearly when Swift, which is the world's largest payments messaging platform with 60, 70,000 plus banks as members, right? It's a not-for-profit member-driven organization. And they start using blockchain for the messaging and integration. That just tells you that as a whole, the banks are now gone beyond being skeptical about crypto and the mixing of crypto and blockchain to now having a clear distinction that blockchain is the technology. Applications vary. And in this case, the applications are for tokenized finance and enablement of tokenized financial instruments, in particular regulated and what's the right term for it? Legal transactions being conducted in the regulated banking ecosystem.
The thing that leaps out at me is that by building its own blockchain to enable transactions between banks worldwide, directly targeting the fast-growing stablecoin market, Swift, in essence, is sending the message that it's no longer a fringe thing. That stablecoin, you have arrived. This is your moment in the spotlight. You are now the belle of the ball. You're officially part of the financial world.
So I actually want, and let me say this, Ajay. I think the stablecoins moment of arrival came through with Stripe acquisition of Bridge. The reason I say this is because it was the first mainstream company in crypto that was actually bought over by such a large enterprise. And what Stripe has actually done has led to this ripple effect. But personally speaking, also since I come from a carded world, I'd say that Visa and MasterCard had made these moves long back. And they tend to
But
play
there's
in this.
something about the Swift imprimatur that almost seems to give it the final word.
Absolutely. Now, this is why it's significant. So, I just wanted to draw the distinction there. What Swift has now done is that it has actually moved into settlement. I think that piece has gone missing from all the headlines, and everybody is signaling the arrival of stablecoins without talking about how the entire financial infrastructure has actually changed. And that's why when Musheer said that the lines are blurring, this is very, very critical, because Swift is a messaging service, but it's now gone into settlement and actual money movement. Now, think about this from the financial infrastructure point of view, from their point of view. Whenever money moves, that's where the efficiencies come in, that's where the costs come in, and that's where the change will actually happen. And this, for me, materially marks that big change where a traditional technology organization is now coming into the foray and actually moving over with this large signal that they have just announced in Cybers.
The other thing that intrigued me was that, critics have dismissed correspondent banking traditionally as slow and outdated, while praising stablecoins as being faster and superior. And that narrative shifts the moment Swift brings blockchain into its rails. So should we necessarily see this as an improvement, or is it? I guess sometimes new technologies promise more than they can deliver.
In my perspective, we've reached that inflection point where blockchain is no longer a new technology. It has matured now. It's been 15 plus years since the Bitcoin blockchain was around, but now you have scale in terms of large millions of transactions running through the pipes every second, minute, depending on the blockchain that you're looking at.
So the time
And
lag
beyond
problem
that,
in the time lag problem in correspondent banking is fixed now.
I don't have to correspondent bank. I'm talking about how blockchains, where even earlier blockchains could not really transact high volumes, right? And now you have tens of thousands of transactions per second taking place in blockchain, and as an extension that goes into millions in few minutes, which means they can do scale. Second, robustness of the major layer ones is quite strong as well. This means as a financial institution, when you're deploying a technology, you need robustness, you need the ability to do large volumes as well. And then that is now fairly secure in terms of the confidence in blockchain to execute that. Now, could Swift or other real-time payment mechanisms deliver something technically within a few minutes? Possible, yes. If you combine faster payment rails and some of the credit card rails, you could do that. I do remittance transfers into India using my credit card on a Western Union app, and that gets delivered to my mom's bank account within minutes, right? So it was never a question of whether it's technology or whether this can be done or not with traditional rails. It was more challenging because of the systems, the processes, and the governance around ensuring everything is accurate and matching of the information, etc., that took a longer period of time for execution. With blockchain, forgetting stablecoins, just generally talking about blockchain, you're able to execute multiple operational elements instantaneously. And that's what makes a big difference in terms of settlement, clearing, checks, etc., etc. Within seconds, you're able to deliver that.
I'll actually tend to agree with Mushir on what he said, but I also want to bring in one particular use case. Ajay, to your point, the correspondent banking related issues, specifically with regards to time efficiencies, have not been solved. But what will be solved, and there will always be a use case for correspondent banking, because we live in a very multifunctional and multipolar world. We have specific instances, specifically of the of the marginalized and the underbanked segments, where correspondent banking will be their only way to receive monies. And we cannot ever discount that no matter how much technology progresses, that particular use case may still only be serviced by the correspondent banking model. But what Swift has now done essentially with this is that there will be a cost cut that definitely will be something that will be visible, not just to the providers in the value chain, but also hopefully to not just the end customers, but also to end merchants. And that's something to definitely watch out for. And secondly, I'm a firm believer, at least in the last couple of years, and specifically since the last decade, whenever a new technology comes in, we always question whether things will change. And then slowly, very, very slowly, things do change. I firmly believe that this is where the sum of the parts will be definitely more than the whole. This will be one place where TradFi and DeFi suddenly start making more sense to people such as who are the actual recipients of this impact, and not just the analysts who are watching this space mostly from the space of also who is getting disrupted and who is getting disintermediated. And we are going a little bit beyond that right now.
That is true. That is the prism through which analysts do tend to view things. Lastly, it's been said that this can unlock interoperable tokenized bank deposits alongside other tokenized assets on Swift's ledger, and that the impact on global payments will be transformational. Again, Musheer, I ask you, would you agree with that, or is this an exaggeration? That maybe someday the technology will get there, but or is it already there? That is the question. Is this the state of the art? Is this the state of the technology as it exists now?
Probably getting there, right? It all boils down to resilience, testing that, and making it sure that the licensed financial institutions are happy with it, right? Because ultimately they are responsible to the regulators, and depending whatever technology they want to use, they are free to do so, but they need to ensure that there is robustness. Has the technology reached a stage where it can be deployed for all of this? Yes. We talk about the 20 trillion odd transactions conducted on stablecoins. 95% of those are for trading settlements, right? Or for a bit of yield in some instances, but not really for real-time payments. But the fact that you've had $20 trillion worth of transactions between Tether and Circle largely tells you that the technology is able to do those volumes, right? And that's what makes it exciting. I think we also saw a recent report from Citi updating about the scale and volume of stablecoins that they expect to increase by 2 to 3x from their initial analysis. Standard Chartered came out saying that they're expecting banks to lose out on $1 trillion or more of flow because of what stablecoins are going to be doing, and private stablecoins are probably going to be the ones capitalizing on it. My perspective actually is that regulated stablecoins are probably the ones that are going to grow the fastest, because as large tradable assets such as treasuries, equities, etc., are coming on chain, and regulated institutions like NASDAQ, LSEG, and others are enabling the same subject to regulatory approvals, you will then need a transactional layer which is on chain. You can do it with off chain layers and real time payments, etc. But when it's on chain, that's a much more compatible system. And those regulated stablecoins will be the ones facilitating it. Hence, you can now say that inflection point is reached where you'll start seeing higher volumes starting from next year on stablecoins related to actual payments. And the percentage of actual payments, both commercial and retail, will start increasing versus just being used for trading settlements.
Largely agree with what Musheer has said. I just want to also draw the fact that there is a lot of work that is being done right now on the issuance of stable coins also by others in the ecosystem. So I see that this space is going to be nicely balanced between traditional financial institutions trying to issue their own, but at the same time, the bridge between the typical Web 2 and Web 3 world is where I see the most impact, with that starting off with regulated institutions actually taking to the ability to use stable coins for various use cases, whether it is settlement or it is money movement. And I see that as the inflection and the starting point more than tokenized deposits, simply because we look at a time frame of say 1 to 2 years, and that's what I can foresee, which is already beginning in the ecosystem.
Yeah, I still see a bit of a generational gap that's dividing TradFi and DeFi, but I guess as with all things, it'll reach a certain critical mass. Enough of the older generation, the older guard, will pass on, and then you'll, at least in theory, you'll have more of a critical mass of people who are more open-minded to alternative methods of payment. But in the time we've got left, are there any closing remarks that either of you would like to make, and anything you feel we we didn't cover anything, any chestnuts or kernels of wisdom you'd like to leave our listeners with?
What I would tell the listeners is that start looking at stablecoins, blockchain-enabled financial instruments from a lens of a technology upgrade and not from a lens of virtual assets and crypto. Keep the two separate. It's a bit like the internet. Initially, a lot of people thought the internet was for watching NSFW content or for doing fun and games, not really a serious part of your daily life. But now all of us are probably a majority of our time online for work or for our entertainment, right? And doing very much safe activities beyond whatever's done. So you don't just blame the internet and say everything is bad or illicit or not kosher, as it were. But in a similar way, what happened in blockchain earlier with unregulated crypto assets, etc., gave it potentially a bad name where people were not focusing on the technology, but we're focusing on the application. So I'm reiterating that, and I feel that's a point worth revisiting for everyone to remember and treat it as the next layer on top of the internet is a blockchain, which is enabling elements, and do not muddle it with cryptocurrencies, which you may have different views on.
That's very salient. Yeah, Monica.
I'd like to say this, and again, because I come from that background, I'd love to be able to look at this from not just the question of what will happen with these particular announcements, but how fast the traditional players are actually not just going to move, but adapt before any of these crypto competitors are going to eat their lunch. And the fact that the thing that we should be watching out most for is what these traditional financial institutions will do versus what they will also not do quickly. And I think the word quickly is really, really critical, because we need to follow the money and what is happening with regards to the infrastructure layer. And when we look at the moves, whether it is Swift, it is Visa, it is Stripe, or it is MasterCard, they're all converging on one definite aspect, which is of the critical infrastructure that they are responsible for, which is blockchain based settlement. And I think the announcements are coming weeks within each other, so that cannot be coincidence. There is definitely something that we need to be looking out for, where the 1-2 year bracket that I talk about is going to see this change.
Musheer, Monica, thank you so much for your time.
Thank you so much, Ajay. It's been a pleasure being back, and thank you again to Pros and the others in the HKU team for facilitating that. Thank you.
Thank you so much, Ajay. And thank you, Musheer.
And we'll be right back. And we're back. Recently, Professor Konrad Borowicz presented a paper entitled Extraterritorial Frictions in the Law of Cross-Border Payments at the European Central Bank's Legal Research Program seminar in Frankfurt. The paper discusses the extraterritorial frictions arising when policymakers seek to reconcile the payment systems of different countries. The main areas of friction are settlement finality, data protection, anti-money laundering, and governance. In his paper, Professor Borowicz proposes several institutional reforms aimed at reducing those frictions, namely a model law on cross-border payment finality, narrowly tailored safe harbors for data sharing, and an international payments forum under the auspices of the Bank of International Settlements, or the Financial Stability Board. The abstract to his paper reads, quote, "In 2020, the G20 placed cross-border payments at the top of the global financial agenda, spurring experiments to make transfers faster, cheaper, and more inclusive," a recurring theme, in fact. Many build on instant or fast payment systems, FPS, yet linking infrastructures is as much a legal and geopolitical challenge as a technological one. When systems interconnect, they project domestic law across borders, generating extraterritorial frictions and giving rise to sovereignty concerns. The article compares three models of FPS interlinking: bilateral links, multilateral hubs, and direct access arrangements, showing how each produces frictions around settlement finality, AML, CFT, and sanctions compliance, and data protection and governance. It then considers various policy proposals aimed at reducing these frictions, such as pre-funding of accounts and the use of privacy-enhancing technologies. The analysis shows that technical fixes cannot resolve the structural frictions of cross-border payments, supporting the view that payment infrastructures embody sovereignty and that integration will likely proceed through regional blocks rather than a single global framework, end quote. Professor Borowicz's paper is currently under review at Law and Geoeconomics, and it's closely related to the work of HKU Law's very own Professor Douglas Arner and Regulatory Ramblings team leader. Professor Arner has done work on the regionalization of payment systems. As Professor Borowicz's background, Konrad is a finance and technology lawyer whose research focuses on the regulation of credit payments and open data. Currently, he's an assistant professor at Tilburg Institute for Law, Technology and Society in the Netherlands, and a research coordinator at Tilburg Law and Economic Center. He has held visiting research and teaching positions here at HKU, FGV Sao Paulo in Brazil, and Nova University in Lisbon. His work has appeared in the Journal of Financial Regulation, Capital Markets Law Journal, and the New York University Journal of Law and Business, amongst other prestigious publications. He is currently developing, together with Emmanuel van Praag, a book on EU payments law and regulation with Oxford University Press. Prior to coming to academia, he was a finance lawyer at the firm of Ropes and Gray in London. And with that, I will turn over to the man himself. Konrad, thank you so much for joining us.
Hey, Jay, thanks for having me. I appreciate it.
So, the topic of payments is very much in vogue, especially, given crypto, given the age of Web3, all of that. What compelled you to write this paper now?
I have a sense, spending a lot of time abroad, right, and sending money abroad internationally. I'm always puzzled by how long it takes, right, and how intransparent or untransparent the process is. So I was really intrigued by why that is the case, and so I started, doing research, and really occurred to me that the global payments network is really a patchwork. Okay, so there's different models depending on the form of payments that you go with, whether it's a card, right, or something else, depending on your provider. But for the majority of payments, account-to-account payments, wire transfer, when money crosses borders, it really travels through a maze of correspondent banks spread across the world, each with its own hours, rules, and fees, right? So imagine sending a message from New York to Bangkok, to use an analogy, right? Because payments really are like messages. So let's use this analogy of the message. Imagine you're sending a message from New York to Bangkok, but you can only send the message through people you personally know, right? There's this really nice concept of 6 degrees of separation, which states that any two people are connected through a chain of at most 6 social acquaintances. So, we can probably pass on that message to our personal connections, but it's really not the most efficient way of sending a message from New York to Bangkok, right? And so, policymakers are obviously aware of this. This is a big issue, for low and middle income countries, where people rely on remittances, international remittances a lot. The cost of those remittances is quite high. So for this reason, among many other, cross-border payments have really become of great interest to global policymakers all the way at the top. As you mentioned in the introduction, the G20 is looking at it, and it has really delegated some authority to the Financial Stability Board to also tackle the problem. And so, the FSB thought, all right, so how do we approach this? And I think quite correctly, the obvious place for them to start was the emerging instant or fast payments infrastructure. Fast payment systems are the modern sort of latest iteration of legacy bank transfers, so account-to-account payments. But fast payment systems can be made, by scanning a QR code, right? And they arrive in seconds. And they really are a miracle of modern finance. So we see the impact they're having in India with the UPI system. We see in Brazil, we see PIX, and then in the Eurozone, we see TIPS. And these systems are really, gaining traction and are becoming very popular among consumers. Each really is like a national Wi-Fi network for money, same currency, same regulator, and same legal playbook. So policymakers thought, why don't we start on this, very solid foundation that people like, that's very efficient. Let's try connect domestic fast payment system across borders. That is the policy push. This is where we see a lot of activity happening, and this is what my paper is really focusing on. Now, the problem starts, as you have highlighted in the introduction, the problem starts with the law, right? Because if you think about payments as messages, there's really no inherent technological reasons why it should take longer for a payment to arrive from New York to Hong Kong, longer than an email, right? It should take approximately the same amount of time because the technology is there. Really, the issue is law and regulation. And so that's what I'm trying to disentangle. What are the different dimensions of law and regulation that cause frictions when payments cross borders?
Is it really just law and regulation? I mean, that there's also the issue of incentives that banks seem to be a power unto themselves, and everywhere in the world somewhere in the world there's a bank holiday, and they can sit on your funds, and that's long been the grievance of those seeking to transfer funds, particularly to the developing world, that the delays of institutions sitting on funds, and that's not a technological issue, that's a governance issue.
That's an excellent point, and I doing law and economics research, I'm very sort of mindful of incentives, and the incentives have to be there as well, right? And so obviously, we may have institutions in the payments sort of space that may not be as incentivized to move or shift to a new infrastructure. They may be quite happy with the existing infrastructures because they're able to extract fees, and so there's that problem that you have to address. When you set up a new infrastructure, you also have to incentivize people to use it in the first place, right? So there's the problem of incentives there as well. And I completely agree. The issue of transparency is huge. I mean, it is just unbelievable, right? Like what happens when you send a payment internationally, right? It disappears from your account, and then, I mean, it sort of disappears from your account. It's debited from your account. So the number you have next to your name when you open your banking app sort of decreases, right? And then the payment disappears, right? And sometimes takes a couple of days before it reappears, right, on the other end of the world in someone else's account as a credit. So there's no transparency in terms of how long that's going to take, and what the fees associated with the transfer will be. That often is also not very clearly stated. So I completely agree that these issues have to be addressed at a governance level as well as a regulatory level.
Oh, very, 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 very much so. Going through your paper, I mean, this was having a legal and academic background myself somewhat. I really felt I could sink my teeth into your paper. It was such a fascinating read, and because ultimately it was clear that this is it harkened back to something my antitrust prof said almost a quarter of a century ago in law school, that the law really is a seamless web. This problem is not just about payments, as you said. It's about settlement finality, it's about data protection, it's about AML, CFT, it's about governance, and so because of the multifaceted nature of the problem, it requires a multi-pronged solution, which makes it more complicated, which leads to my next question, which is, you talk about three models of FPS interlinking: bilateral links, multilateral hubs, and direct access arrangements, yet each, as you say, produces frictions around settlement finality, AML, CFT, sanctions, compliance, data protection, and governance. What then is the solution if each approach has its own challenges? Is it a hybrid approach that you have to take?
I think there's a lot to be learned from each of those models. So perhaps it is worthwhile to consider, what each of those entails, very briefly. So as you mentioned, we have this bilateral model, which is something that really seems to be working well between Singapore and Thailand. So Singapore and Thailand have established this bilateral link between prompt pay and pay now, so the two instant payment systems in those two jurisdictions. So in this model, we have two countries, right? Two central banks, obviously lots of lawyers, right, in the middle drafting agreements, so that a Thai tourist can scan a Singapore QR code and pay instantly, right? This is what the bilateral model between Singapore and Thailand really is meant to achieve. And this seems simple in principle, right? You agree on certain things. Establish a secure API between two systems, agree on FX conversion rules. But because the legal systems differ, right, the legal arrangement has to specify everything, as you've mentioned, right? It's about data protection, right? It's about dispute resolution. It's about sanctions. It's about governance, right? Who has a say on how the system runs? So it's a complicated arrangement to set up, and there's a lot of uncertainty as to how it will operate under stress if there's actually some issue that comes up. How will this be resolved? Currently, it seems to be working quite seamlessly, but I think there's a lot of residual uncertainty built into the system. We have another model, which is the multilateral hub, and I think a good example of that is the Project Nexus, operated out of Singapore from the Bank of International Settlements Singapore hub. And here, instead of building many two-way bridges, we're creating a central hub that connects everyone at once. And there's several Asian countries that are participating. Each of them plugs into the hub, and the hub handles the translation of the messages, FX, routing. It's a bit like flying through Dubai, right? You just need one international airport to reach the world. The good news and the benefit of the system is that you just need one set of rules, right? For all of the participating countries. And in principle, we can envisage all countries in the world could participate. It could be a global system. Now, the bad news is everyone must agree on those rules, right? And whoever runs the hub, say the BIS or a consortium of central banks, acquires a lot of soft power, which is something that you have also alluded to. These governance arrangements come with power of hard and soft type. So in this context, the governance question, I think, looms large. Are we going with a one jurisdiction, one vote arrangement, right? That sounds fair, but potentially can hamper the decisiveness of the system. It may take longer to change rules. So I think that's the major drawback of the multilateral model. And I think finally the third model is the direct access model, whereby you essentially give access to non-resident financial institutions, so financial institutions from another country, to your own domestic payment system. And that is something that policymakers are also exploring, an option that they are exploring. But I think here the legal and regulatory issues are really big, right? Because you're effectively letting in someone who you can't properly supervise. So you have to rely on some sort of an equivalency regime to make this happen. But there's lots of risks that you're creating. And also, there's governance issues as well, from the perspective of the third country, right? Like, are we allowing our own institutions to participate in a system over which we have no control? I mean, that's a major, I think, question that countries will struggle with.
I concur that there are clear drawbacks to the multilateral model. I mean, harmonization seems doubtful. I mean, if everyone was agreed to the rules, I mean, clearly the unspoken lurking variables in the background are national sovereignty, turf wars, and the like, and each state having its own data protection regime, and the trust factor. I don't think it's I don't think it's really about technology anymore. I think there's the issue of trust, and there's the issue of exercise of sovereignty within one's own jurisdiction. You suggest the model law on cross-border payment finality and narrowly tailored safe harbors for data sharing. But that's just it. I mean, is it conceivable that they may construe such a on paper, multiple jurisdictions could more or less have the same rules, but the application is different, and that's where it falls apart.
Exactly, exactly, AJ. And I think, I think in the introduction you mentioned Douglas's Arner's work, which was really an inspiration for this research as well. And I think where he lands in his own thinking with his co-authors and his Dias paper, as well as some of his other publications, is that ultimately it is probably more realistic to think of the emergence of payment blocks, right? Regional payment blocks, rather than some sort of a global utopia of a multilateral hub that connects everyone. All right, so I think Europe already has the single European payments area, and it has the instant payment system that operates across the Eurozone and beyond that. So I think that's a nice model, and I think that's actually a model that Douglas, Arner, and others have suggested could be replicated. But I think ultimately the reason why I think regionalization, the emergence of regional payment blocks, is most likely is because those trust issues that you have highlighted, AJ, are probably the least problematic, right? Or sort of less not as severe in the context of regional blocks where countries, trust each other a little bit, a little bit more. Not always, right? But they tend to, because they have established trade relationships, right? And they have to cooperate because they have these trade relationships, right? So payments and trade, I mean, these two things go hand in hand. So if you want to improve regional development, economic development, you have to think about payments as well. And so I think there's going to be a lot of push for improved regional payment infrastructures. So I think this is what we should expect. Now, in terms of solutions, these regional blogs, they will also have to adopt their own solutions, right? So it's not like the very proximity, or even close economic ties resolve all of those contentious legal issues. We still have to think about how to, fix those issues such as settlement finality, compliance, data protection, right, governance.
In the back of my mind, I mean, and this is timely because we're in an age now where people are genuinely, because of the situation with tariffs on the US and China, and the BRICS nations coming together, not necessarily out of choice, but out of necessity. I mean, there's huge distrust between China and India. But you were talking about regional payment blocks. I mean, and that's they're actually starting to talk about that now. A BRICS payment system, and beyond that, maybe a payment system for the global South, outside of the SWIFT framework. But in a world of regional payment blocks, then what are the implications for the globalization of commerce if those payment blocks don't talk to each other or don't easily connect with each other? Because the suggestion is perhaps that, maybe at least the way I'm reading it, once you're in a particular payment block, you're stuck in it, and you trade within that block, minimal interaction with the outside of that block, and there's a whole other payment process you have to go through to deal with people outside of that in other blocks, and so it makes it costly and cumbersome to interact with and trade with people in alternative blocks.
No, so I think we have to be clear. It is not like the system is going to fragment completely, right? But I think what is likely to happen is that we will have parallel systems develop and to some extent compete, right? Complement each other, but also compete to some extent. Right? So
people will be engaging in multiple blocks at different
I think,
times.
right. So I think a useful analogy is with retail payments, right? So for a long time we have grown accustomed to paying with just cash, right? I think throughout the 70s and 80s, right, and then perhaps even throughout the 90s, that was probably the default payment option for most people around the world. In some places, I guess we had checks, right, and maybe in commerce, obviously other types of negotiable instruments. But for most retail payments, it was cash, right? The payments revolution that has happened over the past decade or really 2 decades that has really blown my mind, right, and has prompted me to study the topic and research the industry and the developments there, policy developments there, created different alternative payment options for us, right? So we can pay, with digital wallets, right? Apple Pay and other types of digital wallets. We can pay with crypto and stablecoins. We can, pay with instant payments. So we have multiple payment options that go through different rails, right? That entail different, fees that rely on different infrastructures and that have different strengths and weaknesses depending on the use case, right? And so I think we are likely to see this in the sort of cross-border space as well, that people are having options, right? Depending on the currency they want to send, because I think we should keep in mind that payment infrastructures are very intimately tied to currency, right? And owing to the central role of dollar in international trade for a very long time, it was obviously the U.S. infrastructure that dominated the global payments transactions, right? But to the extent we are seeing some shift towards alternative currency arrangements in terms of settlement of wholesale but also retail transactions, right? We will see, I think, alternative infrastructures, payment infrastructures, moving these currencies become more popular and grow more popular with users. And so I think ultimately it's not a story about a complete fragmentation, right, of the global payment system, but it's rather, I think, the likely scenario is the emergence of parallel payment infrastructures, right, that serve different users in different contexts, right? And I think the regional focus is really important because we do want to strengthen regional trade. I think because of the geopolitical tensions, we are becoming more aware that these regional relationships are important, and so we want to make them, more efficient. And one way of doing this is through boosting and improving the regional payments infrastructure.
I want to pick up on the issue of sanctions because, and again, that too is topical and timely because of the whole issue of sanctions on Russia post 2022 invasion of Ukraine. That the whole issue of different payment blocks is interesting in the context of sanctions because one might conclude, okay, fine, if the West is going to ostracize me from SWIFT, I'll create my own payment system. I'll create my own that those that want to trade with me can participate in, and that again, that doesn't mean the dollar is not powerful. That doesn't mean SWIFT is not powerful, and it's a big disadvantage to not have access to it. I mean, but we saw that a decade ago with the whole UBS case in Switzerland, that to be cut out of the American banking system means, for practical purposes, to be cut out of the global banking system because most transactions are in dollars. But that was a decade ago. Now people have more choices. can we therefore not look at multiple payment blocks as a way to circumvent sanctions?
Yeah, and I think sanctions are probably one of the main drivers of the emergence of these competing payment infrastructures. We mentioned the UBS case. We also had this, famous BNP Paribas case back in 2014, right? When
Yeah.
not just a decade ago, but I think it was probably one of the first sort of moments when people realized, well, there's actually a risk associated with using US dollars as a currency for certain transactions, right? And BNP Paribas got caught right in the middle, moved money on behalf of countries under US sanctions, right? And even though the bank was French, because the dollars flowed through Fedwire system, the system physically and legally sitting in the United States, the American law tagged along for the ride, and obviously now we see more sanction regimes emerging, and they are conflicting with each other. So that's a major concern, I think a major driver. And I think this is also the most difficult issue to solve. It's, I think, much more difficult to solve than the issue of money laundering, right? So anti-money laundering, we have a global baseline standards developed for this by the Financial Action Task Force. So there's a lot of harmonization with respect to AML rules, but sanctions are straight up geopolitical weapons, right? They are how countries project foreign policy through finance. The US sanctions on Iran or Russia, right? We can imagine the EU sanctioning someone back, and then China retaliates, right? And suddenly your cross-border payment becomes really a hostage, right, of global politics. And I think this is a very difficult issue to solve. I think, ultimately, this is probably the reason why these regional blocks, competing blocks, will emerge, because people will simply disagree on, as a political matter, on what should be sanctioned and what should be the implications of that for transactions. So in my paper, I admit I don't have a good I don't have a good solution for this. I think it is just ultimately a political question, and there's no legal or for that matter technological fix for this.
It's also interesting because, I mean, it does bleed into international relations, because the Americans, I understand, were recently telling the British Post, the British had just signed a trade deal with India, and they were telling the British, we want you to impose tariffs on your trade with India as well. And the British said no. That, we will not always agree with you, and we will not. The Keir Starmer administration's position was, we will not always agree with you, we will not always support you, but that doesn't mean we disagree with you. Of course, given the temperament of the current administration in Washington, I'm not sure if, given their absolutist positions of you're either with us or against us, that's necessarily going to sit well with them. But the other thing that occurs to me is that, it's said that in the 21st century, data is the oil of this century, that it is so valuable, and therefore it seems to me a key emphasis has to be on data protection. And it's interesting, again, how interconnected this is with other subjects, like, for example, the issue of cross-border data transfers as banks operate across borders, and certain clients have accounts and activities across borders. This has implications for KYC and AML. That banks need to be able to move that data across borders to do effective KYC on their clientele. Yet, because of different domestic rules on data privacy in each jurisdiction, that becomes a perennial and sometimes inexorable challenge. And this is a problem as old as AML KYC compliance itself. Is there any way around that? I mean, What is the data protection fix in this instance to facilitate smooth, seamless payments with the minimum of fuss?
So before I answer this question, let me just refer back to what you mentioned. Beautiful, at least from the point of view of a legal scholar, okay? Because as a matter of practice, this is just a nightmare, right? But from the point of view of a legal scholar, there's a beautiful tension between AML on the one hand and then data protection on the other, because AML would like full transparency. Data protection is like, no, we cannot have full transparency. We need to protect people's data, information. And so there's this beautiful tension that is really difficult to reconcile, right? Domestically, and
I
certainly
can give you security, or I can give you perfect security, but
Yeah.
you're willing to sacrifice anonymity.
Absolutely. So there's trade-offs, and you have to strike a balance somewhere, and where that balance lies is not an obvious. It's not that obvious, right? So there's a tension there. But to data protection, well, again, this analogy between a payment and a message, right? And it's really not much of an analogy because a payment really is a message. So when a payment crosses borders, it carries with the message personal data, names, account numbers, transactions descriptions, right? A lot of information.
That's a good point. The nature of the payment itself is itself a message.
Absolutely. And so, if that's the case, you can easily understand why there's so much information, including personal information, that sort of travels with it. Now, from a European perspective, under the General Data Protection Regulation, the famous or infamous GDPR, that data cannot leave the EU unless the receiving country can guarantee essentially equivalent privacy standards. Okay? Now, think about it. The phrase essentially equivalent, right, sounds like a legal scholar's love letter to ambiguity, right? Essentially equivalent. What does that even mean? And that phrase has really occupied people's minds for the past decade, also in the context of Brexit, but also in the context of data protection. So, every time you send a payment, say from Paris to Bangkok, okay, Europe to Asia, any system we have has to check, does Thailand have an essentially equivalent data protection regime, right? If not, the payment operator in the EU must rely on some other safeguards. For example, contractual safeguards, and the EU has developed a set of standard contractual clauses that can, help set this up as an institutional matter, right?
But if you do it contractually, that'll have to be done with each individual institution you deal with in that jurisdiction.
Pretty much, right? And so obviously that imposes a cost, right? And beyond that, that's digital extraterritoriality, right? Brussels privacy law now available globally, right? The famous or infamous again, Brussels effect. And so we have this issue, and courts have really doubled down on this in this famous Schrems II case. The Court of Justice of the European Union has killed the previous US-EU data transfer deal precisely because there was a sense that American authorities would be able to access personal data of European citizens whenever it was transferred to companies in the US. So we do have this big issue. Now, how do we solve this? Well, I think there's we're putting a lot of faith into these standard contractual clauses, these arrangements between regulators, but also individual institutions, right? So you have to consider both levels. But that is something that, again, is not bulletproof, right? There's also a question of how are these going to be implemented as an operational matter? Are courts going to uphold this, right? So there's issues, I think, around this. And so another option is, and I think, I have some faith in this, and that's the point I make in the paper also, is privacy-enhancing technologies, right? So these are tools like encryption and tokenization and some form of secure computation that lets systems verify data without actually seeing identifiable data. So a bit like a custom scanner that can detect, contraband without opening your suitcase. That kind of arrangement. And the policymakers, the BIS, IMF, are looking at this at privacy enhancing technologies. I think it's genuinely promising. But again, I think we come back to this issue of trust. Like how do you how comfortable you are with relying on technologies for this purpose. So maybe the ultimate fix is going the regional way, right? Because you probably have more trust in the data protection regimes of countries that you know well, rather than countries on the other side of the world, the data protection laws of which you don't know that well. So I'm afraid that even with privacy enhancing technologies, I think the way forward may be still the regional way.
Let's take a step back and look at things from a very macro level. The BIS and the FSB are legacy organizations, and they're slow to change. They may make pronouncements about financial inclusion and risk-based compliance, but that all too often falls on deaf ears as banks engage in wholesale de-risking, unbanking of clientele. Should we therefore, because they are legacy institutions, they are slow to change, should we really be looking to them for solutions to provide a forum, as you put it, for transnational payments?
You mean like institutions like the BIS and
Correct.
there's public ones. Listen, I'm a big fan of the BIS. I think they're doing tremendous work on the policy side, and I think these experiments that they have been launching and developing in payments and retail and wholesale. I mean, they have been really very interesting, and they are very promising. And there really isn't anyone else who could do this currently. So I think at a global level, we need these institutions. I think regionally there's alternatives, and I think certain countries may want to take a lead on some of these initiatives. So I think,
but then that lends itself to the whole block,
correct.
different regional block payment block systems.
Correct. And so I think, and this is what we're seeing, as a matter of fact, is that we will be seeing these experiments run in parallel. And I think people will be watching and thinking which system works best, which one deals with these fault lines and frictions that we see in cross-border payments in ways that we deem acceptable. And so I think that's a very healthy sort of thing to have, this sort of competition between.
Multiple laboratories running
Correct.
experiments in tandem.
Correct. And I think, in the past, these global policymakers probably, they were probably more influential, and there weren't many alternatives and many competing sort of, policy projects. I think now there's more competition in this space, and maybe that's a good thing.
Perhaps. I mean, I do think there's something to be said for people having choices. Like, again, the current administration in Washington is almost militaristic in its view of maintaining the hegemony of the dollar. But I think that ship has sailed. The dollar is still important. It'll still be around. But now people have choices. And the greenback, even if it has a seat at the table, it's going to be important. It may even be first amongst equals. But people have choices, and that bothers some people. But in terms of your paper, what do you think it adds to the existing literature on payments? Because in recent times, we've seen a great deal of literature on payments.
Right, and that literature has really been a big inspiration. But I think what we haven't seen is, number one, a good account of the policy experiments that are happening. right? Because we have reports from the policymakers who are running those experiments. These are individual reports, the prompt pay, pay now, Singapore, Thailand link, right? Project Nexus, tips. These are happening in parallel. So what I wanted to do is to take them and compare them, right? And really see what the institutional arrangements are. What are some of the strengths and weaknesses from an institutional standpoint of these different models? So I think this is one thing that the paper adds. And the other one is it really talks about the retail segment of global payments. So I think, people have been really focused in the past on financial market infrastructures, but understood as wholesale market infrastructures for the settlement of securities trades and big big wholesale payments between banks. But I think the focus of these policy experiments that I have alluded to is really on retail and on the ways in which people send money to each other, right, through remittances or through other channels. And I think we haven't thought enough about the institutional arrangements that make this happen. And so I think the focus has really been in the paper on the retail side and the data protection and AML issues that these types of payments give rise to.
In light of the fact that we're firmly in an age where crypto is a factor, it's no longer just a fringe thing. How do we look at your paper and the conclusions you reach, and your observations? What or does it complicate any of what you argue, or should we just look at them as just parallel universes?
Right, so crypto is a universe. I like the phrase, and it's a universe of different types of tokens, some of which are designed and meant for payments, but not all of them, right? So we have to sort of make that clear. I think probably the most excitement at this time is around stablecoins, and people believe that stablecoins can be used as an alternative payments method, right? But I think that still remains to be seen whether the underlying infrastructure will be sufficiently developed, will overcome the collective action problems that are inherent to any payment infrastructure. You need to attract a critical mass of users, right? The infrastructure should be interoperable with other systems, ideally, right? So I think this will be major technological challenges and economic challenges that stablecoins will face. So I'm not close-minded about stablecoins, but I personally believe that it is probably instant payments that hold the biggest promise for improving cross-border payments. The biggest promise for payments that are, legally compliant, right? Because I think the issues around stablecoin payments, the compliance issues are much bigger, and the issues are the issues that I mentioned are even greater in the context of stablecoins. So I think that's why I decided to focus on instant payments, simply because of my belief that they hold the biggest promise as a lawful form, very efficient lawful form of cross-border payments for the world.
Coming back to the earlier point about how sometimes the mere act of a payment is information in itself. I mean, I'm struck by the views of a Canadian ad man whose ideas were very popular in the 60s, that the medium is the message. Right. And it's interesting that it almost seemed to apply in this context. But in the time we've got left, is there anything you'd like to say that you feel we haven't covered? I mean, how would you sum it up? Well, what's the central takeaway?
Sure. So I think maybe let me just say what this I think means for people, for different sort of people, right? I think we should not be particularly concerned. I think we should be excited about what's coming. I think if you are a consumer who makes a lot of cross-border payments, the future looks very promising. People will be able to send money abroad instantly through apps. The interfaces will get smoother, right? The FX spreads will get tighter. That's a good thing. But I think what we should appreciate is that under the hood, right, every transaction is really a negotiation of sovereignty on your behalf, right? So if you're a business, you will likely face a more complicated regulatory map, right? Different reporting standards, data laws, and compliance checks, depending on the corridor you are moving money through. And if you're a policymaker, I think you quickly realize that the payments are not just a borrowing back office issue. They really are, foreign policy or diplomacy. And so I think we are slowly, policymakers are slowly awakening to this realization. And I think, now's the time to appreciate that and engage in payments diplomacy.
Konrad Borowicz, thank you so much for your time.
Thanks for having me, AJ. Appreciate it.
And to our listeners, thank you. Until next time.